Good day, everyone. I hope that you're staying well and that you're able to keep your work-life balance, just that, balanced. Okay? Today we're going to talk about money. As we sometimes like to joke, everyone's favorite thing. But we need to talk about what money is, and in some sense what it isn't, and where it comes from. And you might go, what do you mean where it comes from? Isn't it coming from, and you insert answer now. But money has a very particular meaning. It, of course, is very important for the economy. We learned in the aggregate expenditure, sure, Jack, spit it out. We learned in the aggregate supply, aggregate demand model that the aggregate demand curve will shift to the right or to the left whenever the planned expenditure line in the income expenditure model will shift up or down. And we know that a change of the money supply can alter interest rates, thereby shifting the planned expenditure line and in turn shifting the aggregate demand curve. So the money supply is important for the determination of GDP in the short run, because a change in the money supply altering interest rates, thereby altering the amount of investment undertaken, thereby shifting the planned expenditure line, shifts the aggregate demand curve, and a shift of the aggregate demand curve will alter the short run equilibrium level of output. So money matters, if you want to say it in a quick way. So in the short run, the money supply matters. And so we want to talk about money, we want to talk about banks, and also the central bank. The central bank is a very different creature than a regular bank. Okay? So again, we want to talk about what money is, but also what money is not. But again, with that sort of reminder in the background that money matters. The changes of the money supply, wherever they're coming from, do matter for where the planned expenditure line is, and therefore where the aggregate demand curve is located, and therefore how well the economy is or is not doing in short-run equilibrium. So money matters in the short run. So again, we'll start with the definition of money. As I mentioned, we'll say what it is, but also what it is not. We'll talk about some different measures of the money supply. I say the money supply as if there's one singular definition, but really there are different measures of the money supply. Different aggregates used to estimate the aggregate purchasing power that is sitting in money. It's almost like talking about the military for a nation. You can talk about measuring how many, tanks they have, how many aircraft they have, how many cannons, how many bombs, blah, 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 and add, the aggregate firepower of the military. Well, these different aggregate measures of the money supply are talking about the aggregate purchasing power that is being stored in particular forms of money. Purchasing power that might get unlocked and used, and therefore influencing expenditure in the economy, prices and output, employment and unemployment in the economy. Changes in the money supply can alter changes in expenditures, and therefore changes in employment, unemployment, and output being produced and consumed. So we'll talk about how money matters. Okay? Yes, today I sort of say it, yes, it matters in the background. We'll keep it in the background mostly, but money matters. We want to understand how it matters for the economy. We'll talk about the role of commercial banks. The word commercial there is in the brackets, which means we usually just say the role of banks. But if I just say banks or bank, a bank, I mean a commercial bank, a private sector bank, usually a bank that is a for-profit entity that tries to go out there and earn funds, earn profits. Okay? So we'll talk about the role of banks and how they influence the money supply. We'll also talk about the role of the central bank. The central bank, because there is one central bank for our nation. But each nation can have their own central bank. So there's the Central Bank of China, is the central bank for China, not surprisingly. The Federal Reserve is the central bank for the United States of America. The European Central Bank is the central bank that represents the Euro group. So all the countries that use the currency called the euro. So for example, France uses the euro. And so France is a member of the European Central Bank. France has its own central bank, So does Germany, which also uses the euro, but their central banks don't behave like Canada's central bank because they're in that special common currency block called the euro. Okay? To use a Canadian analogy, Alberta uses the same currency that Ontario does, just like France and Germany use the same currency, but Alberta does not have a central bank, and Ontario does not have a central bank. We participate as part of the union that is Canada, and we have the Central Bank of Canada, the Bank of Canada being the central bank for all provinces and territories within the nation of Canada. So we'll talk about the central bank and how central banks can influence the money supply. So you notice that commercial banks matter for the money supply. So does the central bank matter for the money supply. Before we go into this in some more detail, I want to emphasize an important assumption that we will make not just today, but in general throughout this course. We will assume that even though commercial banks matter for the money supply, we will assume that the central bank has control over the money supply. We will assume that the central bank can pull strings or do things behind a curtain or whatever. They can make things happen that if they want to keep the money supply constant, they can do so. If they want the money supply to rise or to fall, they can make that happen as well. If they want the money supply to grow by 5% a year instead of 3% a year, they can make that happen. So we're going to assume throughout this course that the central bank has control over the size of the money supply and its growth rate. In reality, though, commercial banks play a role as well. And so in reality, the central bank does not have 100% complete control over the money supply. They influence the money supply. They can make the money supply rise or fall, but not necessarily perfectly, because they don't necessarily have perfect control over it. It's kind of like taking a dog out for a walk, but you don't have a leash. You don't have perfect control over where that dog goes. Okay? So, like I say, private sector banks, commercial banks matter. So does the central bank. Okay? So when we're talking about money and monetary policy, it's important that we know what is money before we talk about changing the money supply. It's important that we know how the money supply is being determined. And so that's the goal today, to talk about what is money and to talk about how the money supply is being determined. Next time, we'll talk more about the role of money in the economy. We'll talk about how changes in the money supply shift that planned expenditure line and shift the aggregate demand curve and therefore influence the economy in the short term. Okay? The emphasis today, it's interesting how it came out weird like that. The emphasis today, like I mentioned, is to talk about what is money, the different measures of the money supply, and to talk about how it's being determined. The role of the commercial banks, the role of the central bank. Alrighty. We'll start with what we mean by money. In economics, money doesn't mean wealth. You get a very rich person like Jack Ma or Bill Gates or Elon Musk, and they are very wealthy. They have a lot of assets that are worth a tremendous amount of money, some people will say. Okay? But in economics, money doesn't mean wealth. Owning some shares in Tesla or in Alibaba or in Microsoft or Apple or whatever, those shares are valuable. They're worth something. They're part of the share owner's wealth. But those shares are not money. Although we might value the shares in units of money. We might say, oh, to buy a share in ABC Corporation, it costs 100 Canadian dollars per share. And so we might value those shares in units of money, but the shares themselves are not money. They're valuable assets that are a portion of someone's wealth, whomever holds that asset or owns it. So in economics, we say a person has a lot of money, right? It means the person holds a relatively large portion of their wealth in the form of money, instead of Microsoft shares or Alibaba shares or gold or real estate or whatever. Wealth refers to all of the valuable assets that a person owns. So if Jack's wealth would be any real estate I own, any financial assets that I own, like stocks, bonds, and other financial securities, right? Money, any gold or automobile or whatever. Okay, so wealth is a big sort of umbrella term for any valuable asset. Could be a real physical asset like land, or a house or structure, or an automobile, or a physical piece of gold. It could be something that is less observable, right? It could be something like, I own a share in Apple, and well, what does that mean? Well, I own a portion of Apple. Okay, so in economics, when we say somebody has a lot of money, it means they hold a large portion of their wealth in the form of money. It doesn't mean that they're very wealthy, it's just the percentage. Okay? What is money? Money is any asset easily used to purchase things. So again, money is any asset easily used to purchase goods and services, or to settle your debts, pay off your student loans, or whatever. So you notice it says any asset. So money could be cash. On the way home from work, I might stop off at a restaurant to order some food to take home for dinner. If I pay in cash, and it's very easy for me to do so, then that cash is an example of money. But if I decide to be more friendly and practice greater social distancing, maybe I pull out my debit card and I use my debit card and I say, yeah, will you take this debit card? And they go, what? And then the assets that are linked to my debit card, if I can easily use my debit card to pay for things, then the assets that are linked to my debit card are money. So money refers to the most liquid assets in the entire economy. All the cash out there in circulation and all the other highly liquid assets easily usable to pay for things. So most bank accounts that you can easily use a debit card to access are an example then of money. Any bank account that you write a check on, and if lots of people are willing to accept your check, then a checkable account would also be money. Okay? You'll notice there's a little footnote there. An asset is referred to being liquid if it's easily converted into cash. So an example that I tend to say is something like this. Imagine I brought to the classroom a bag of $50 bills, and I pour them out onto the table, and I say, yep, there's $100,000 in $50 bills. So $100,000 in cash. And then beside that, I put some bars of gold. And I say, there's $100,000 in gold. And beside that, I put a painting. And I say, the foremost expert on this particular artist has valued this painting at $100,000. Each of the three piles, each of the three assets, are equally valuable, each being valued at 100,000 Canadian dollars. But the cash is money, because the cash is liquid. You can go to the pile of cash, grab a $50 bill off the pile, and spend it at Tim Hortons probably fairly easily. If you grab one of the bars of gold and go to Tim Hortons and try and buy coffee with it, good luck, because the bar of gold is not as liquid as the cash money is. To convert the bar of gold into purchasing power, you have to find someone willing to buy bars of gold. You have to go to a bank or some sort of specialized place where they commonly buy precious metals like gold and silver. So they can look at it, they can look at the market value, and you guys can come to an arrangement. That makes the gold less liquid than the cash. And because it's less liquid, then it's not money. In Canada, gold is not money. We go over to the painting. The painting is even less liquid than the gold is, because the painting's worth $100,000 supposedly, but good luck finding somebody willing to pay you $100,000. Good luck finding somebody willing to trade that painting for some coffees and make change. To sell the painting, you have to take it to a specialized art auctioneer or art dealer, and they might auction it off or hang it in their gallery, and it may or may not sell, and it probably is not going to sell right away. It might take weeks or months. And then you have to get your settlement. It takes a lot of time. So I had 3 different assets there: $100,000 in cash, $100,000 in gold, and $100,000 tied up in a piece of art, a painting. And each of those assets had different degrees of liquidity. The money, being cash, was the most liquid of the 3 piles. The gold is non-monetary asset. It's part of my wealth. I'm holding in a non-monetary asset, and it has less liquidity because it takes time to convert it to money before I can spend it. And the painting is even less liquid again. Okay? So money is the most liquid asset in the economy because it can be easily used to pay for stuff. It already is cash, or it already is something that is very cash-like. The assets linked to my debit card are almost perfectly substitutable for cash. In almost every instance where I can use cash, I can use my debit card. Okay? So the kinds of assets that we count as money depends on how narrow or broad of an aggregate we want to use. Okay? So there are several different definitions or measures of the monetary aggregates. 3 of the most common ones are right here on this slide, on the screen. There are others. And look at the name: M1, M2, M3. M for money, definition number 1, M1, then number 2, then number 3. Okay? And so M1 is a narrower definition than M2. You'll notice M1 has certain things in it. M2 has everything in M1 plus some more assets. Similarly, M3 has everything in M2 plus some additional assets. So narrow, broader, broader again. And as we add more assets in, the assets that we're adding into the pile and calling money are less liquid than the earlier definitions. So M1 is the narrowest definition of these 3. It's also the most liquid. M2 is a broader definition, and we broaden by including more assets with a reduction in liquidity. M3, we broadened further, and we added some more assets with even less liquidity. What's in M1? All the currency in circulation. All the cash out there in the economy that says Canada on the front of it, since we're talking about Canada. So all the currency in circulation, plus all the demand deposits and other checking deposits at chartered banks. A demand deposit is a bank account where you can go to the bank and you can ask for all or most of your account balance in an instant. You can say, what's the balance on the account? 5,000? Well, I want 2,000. Or I want $500. And they can't go, whoa, you can't do that. So a demand deposit is a very liquid bank account because you can empty a large portion or even the whole account at a moment's notice. Okay? So cash and very cash-like bank accounts at the biggest banks in the country. Chartered banks are the biggest banks in Canada. They're the ones with a greater retail presence. They've got more online services, more telephone services, more branch services than the other banks. Okay? So that's M1. All the cash and very cash-like bank accounts at the biggest banks in the nation. M2, everything in M1, but now we're adding in some more bank accounts, still at chartered banks. But the bank accounts that we add in have less liquidity than a demand deposit. You don't have the ability to write a check on the account, or you don't have the ability to link it to your debit card. So these are personal term deposits, and non-personal, that means business, nonprofits, this sort of thing, governments, demand and notice deposits at chartered banks. A notice deposit is an account where when you go to the bank and say how much is in there, and they say 5,000, you say, okay, I would like to take out 2,000. They can stop you and say, no, you're not allowed. Because this is a notice deposit, you have to give us prior warning 3 business days in advance or 5 business days in advance. You have to warn us in writing. You have to send us an email through official channels of a particular form to warn us you're coming to get some of the money so we can make arrangements to make the money available. So a notice deposit is an account that has less liquidity because the money's more locked in. A term deposit is also an account with less liquidity because the money's locked in for some term of time. If I went to my bank and I talked to my private, my personal banker, and I say, yeah, what's the interest rate on my demand deposit on my checking account? They would tell me that it's terrible. The interest rate is almost 0. I think my demand deposit, the debit account I have, pays me 1% of 3%. 1% of 3%. That's basically 0 because that's 1% times 3%. There's a lot of zeros there before you get to a number after the decimal place. A demand deposit pays an interest rate almost the same as cash because a demand deposit is almost perfectly substitutable. It's almost the same as holding cash. A term deposit is a bank account that they lock the money in. They say, well, tell you what, we'll give you a bigger interest rate. I talked to my personal banker. Why is the interest rate so crummy on my debit account? They say, well, if you want to set some money aside as savings, what we'll do then is we'll open up a term deposit and you can lock it in for 30 days. Or you can lock it in for 6 months. Or you can lock it in for 5 years. I'm like, 5 years? Yeah, for 5 years. If you agree to that, Jack, we'll give you a higher interest rate. Usually, the longer you lock it in, the higher the interest rate they give you. Because you've given up liquidity. You give up liquidity in return for a higher rate of interest. Okay? So M2, we're adding in these accounts with the reduction in liquidity, but yet we're still calling it money. M3, everything in M2, and we add in some more accounts with even further reductions in liquidity. Now we've got non-personal locked-in accounts, term deposits, and foreign currency deposits. So any bank accounts that are not in Canadian funds. In Canada, most foreign currency deposits at chartered banks are accounts in American dollars. But it could be in Hong Kong dollars or Japanese yen or euros or British pounds or Chinese yuan if your bank will allow that. Right? A bank account in foreign currency has a reduction in liquidity versus a bank account that's in Canadian dollars. Because when I'm on my way home after work, I don't try and pay with a debit card that pays in American dollars to buy something in Canadian dollars. The fees would be really troublesome. To use that account, I have to either physically go to the bank and get things exchanged into Canadian funds, or I have to get on the telephone or on the internet and do things. It takes more time and more fees. That confers less liquidity on that account because the account is not ready to go to spend in Canadian funds very easily. Okay? So again, the narrowest definition, cash and very cash-like bank accounts at chartered banks. A broader definition, we're adding in personal term deposits, non-personal demand and notice deposits. And M3, further broadening, we're adding in non-personal term deposits and foreign currency deposits of Canadians. Okay? Those are the 3 aggregates that we mentioned today in class. But when you're reading the textbook or you're reading things online, you may encounter M1 plus or M1 plus plus or M2 plus or M2 plus plus. And it's like, what? Well, a plus means we're adding in even more assets. A common thing that we have with M1, M2, and M3 is that we're looking at cash in circulation, not sitting in a bank vault, as well as certain chartered bank accounts. M1 with a plus would include similar bank accounts at institutions that are not chartered banks, at credit unions, at Caisse Populaires, which is a French-Canadian credit union, at mortgage and loan companies, trust companies. These are other banking institutions that are not chartered banks. So M1 Plus has very similar assets. It's got everything that M1 has, all these assets, plus it has M1-like assets at other institutions. M1 Double Plus includes some more of these assets at these other institutions. And similarly with M2. M2 Plus has all the stuff at M2, plus some of the same assets at these other institutions. M2 Double Plus adds in even more of these same things at these other institutions. So we can broaden by going from M1 to M2 to M3, broadening this way, by adding more assets at the same type of institution. Or we could broaden by having M1, then M1 Plus, and then M1 Double Plus by adding in similar assets at more institutions. Ugh, very scary. There's too many aggregates. So we pick one generally and stick with it. So for this course, we'll probably stick with M1 because it's easiest to imagine. Currency in circulation, so cash, plus demand deposits and other checking deposits at chartered banks. And for me, I either pay cash or I haul out my debit card to pay for things. So I generally use M1. My debit card is from a chartered bank. If my debit card was from a trust company or a mortgage and loan company or one of these other institutions, then I would not be using M1 when I use my debit card. I'd be using M1 Plus or M1 Double Plus, depending upon the nature of my account at the institution where it's at. Okay. Ooh, washed out. Okay. Whoa, now it's really dark. How come I can't control that better? Okay. It's the italics get washed out when the light's too bright. So we're going to talk about money again. Money is any asset easily used to pay for things. We said that earlier. But assets to function as money need to have three properties. So any asset to be money needs to be the medium of exchange, it needs to be a store of value, it needs to be a unit of account. Medium of exchange means that people use that asset to trade that asset for goods and services, right? Rather than consuming that asset. So medium of exchange means the asset is the means of payment. You use it to buy stuff. Okay? In the past, before we had the current monetary system in Canada, historically we've had a number of different monetary systems that have evolved over time. There were periods of time in the past where in Canada we were on what's called the gold standard, where the money was either made of or backed by gold. And we'd be using gold to pay for things. We'd be using gold coins, or we'd be using paper notes that are backed by the gold. And so in some sense, we'd either be de facto paying in gold or implicitly paying in gold because things were based on gold. But we could have used the gold for some other purpose. We could have taken the gold coins and hammered them into jewelry, right? But instead, we've used it as a monetary thing for exchange. The use of money eliminates what's known as the problem of the double coincidence of wants. If I'm on the way home from work and I want to buy some food to take home for dinner because I'm hungry, I have a want. I want food for dinner. But I go to some place and I say, do you have food that you prepared? Yes, you do. Oh, great. What's your menu? Oh, I like some of the stuff on the menu, so I want some of the things they have. If we don't have money, if we're having a system where we don't use money, then I have to have something to trade to them. They have to say, yeah, I have some extra food. I say, well, that's great. I love this fried rice I see here. You got some extra of that? Yeah, you do. Great. Fried rice. I'm really into that. They say, what do you have to trade? I might say, well, I have a watch. Would you need a watch? And they're like, no, not really. I don't like your watch. It looks ugly or whatever. So in a system where you don't have money, where trades are based on barter, you have to trade goods and services for goods and services. I might say, well, what do you need? They say, well, it snowed yesterday and there's all kinds of snow in the parking lot. Why don't you go shovel out my parking lot for me? I said, well, how long do you want me to shovel for to trade for, one order of chicken fried rice? They might say, well, you shovel for 25 minutes and we'll trade you the chicken fried rice. I might say, are you kidding me? 25 minutes? No way. 15. And so we might, negotiate, and we might come to a conclusion, and we trade my goods and services for their goods and services. But when you don't have money, that is really a problem. I need to find someone who has something that I want to buy or exchange for, and I have to have something that they want to buy, because we're trading what I'm selling for what they're selling. But having money makes it easier, because I just find someone who's selling something I want to buy, and I pay them in money. And they use the money in turn to hire someone to clean out their snow-filled parking lot or whatever. Money simplifies transactions because it removes the need for the double quintessence. I sell the goods and services that I sell and produce for all the money that I can earn for them, and I turn around and spend the money to buy the goods and services that I want. My buying and selling become separated because I sell for money. I don't sell for dinner, although ultimately the money could be used to buy the dinner. So money acting as the means of payment simplifies our economic exchanges. There's less search costs to find a reasonable exchange. There's less transaction costs and negotiation costs. Money, for an asset to be money, it also has to be a store of value. A store of value means that it maintains some value over time. So a store of value means the asset allows us to store some purchasing power in the asset over time. So if it's now spring and it's getting warmer, and I reach in my closet and I pull out my spring jacket because it's so much warmer, and I reach in the pocket and I find $20 bill, I go, yes! Because that $20 bill, even though it was left in there months ago, is still valuable. Money maintains purchasing power over time because it acts as a store of value. If I reached in the pocket and I pulled out a $20 bill and I was like, oh man, and I look at it, it has an expiry date, and it expired, December 31st, 2020, and I'm like, darn it, I should have spent this before then. Well, then I'd be upset, wouldn't I? But money doesn't behave like that, does it? It's not like a coupon that expires. A $20 bill that says Canada on the front of it is worth 20 nominal dollars of purchasing power for the rest of time. A 20 nominal dollar bill is a perfect nominal store of value. Why do I keep stressing the word nominal? Because the real value of money depends upon the aggregate price level. To the extent that the average price level is measured by, say, the consumer price index or the GDP deflator, we tend to see the average price level rise over time. We tend to see inflation. I reach in the pocket of that jacket, I pull out a $20 bill. It says $20 on the front. It doesn't say 19, it doesn't say 21, it says 20. And it always says 20. So it's a perfect nominal store value. But if the average price level is rising thanks to inflation, then that money is seeing a real depreciation. Its real purchasing power is actually declining. The higher the rate of inflation, the faster the real value of money is declining. So to keep money a good store of value, we need inflation to be low. In Canada, the Bank of Canada, Canada's central bank, has one primary goal that is more important than all the rest, and that primary goal is to keep inflation under control. They sign 5-year rolling contracts with the government of Canada, and those contracts stipulate that the main thing that they should worry about is inflation. And they want to keep inflation as measured by the consumer price index no more than 3% and not less than 1% per year. Hopefully close to 2%, the middle of that band. They're trying to keep money as a good store of value. Because if money's a bad store of value, then why would I want to accept it as a means of payment? I'd be asking, can you please pay me in gold? Can you pay me in chickens? Can you pay me in foreign currency? Because Canadian currency is very, very bad because we have such a high inflation rate, eroding the real value of the money rather quickly. So in Canada, the Bank of Canada targets the inflation rate to maintain the store of value function of money, to keep it functioning as money. Number 3, for an asset to be referred to as money, it has to be the unit of account. It's our commonly accepted metric to measure value in the economy. People say, oh wow, nice pair of shoes. Right? Those are gorgeous shoes. What did you pay for them? No, people don't answer generally, oh, it cost me 400 peanut butter and jelly sandwiches. Unless they're, a unique, we always have unique friends. Right? I still remember my daughter had a friend in grade school who said, my name is this, but call me Seven. Right? And I was like, what? But anyway, people are unique. Unit of account refers to the fact that we measure things in units of money. How much did that handbag cost? How much is your tuition? How much is dinner? And we say how many monetary units it cost. How many domestic currency units. If you and I are both from another jurisdiction, then we might hold that conversation and talk about what things cost in Hong Kong dollars. And people might go, why are you talking about Hong Kong dollars? Did you buy that handbag in Hong Kong? No. Well, then why did you mention Hong Kong dollars? Because it's a common frame of reference. It's a common unit of account that both of us understand, and we both know how hard we have to work to get that many Hong Kong dollars, and therefore how much I sacrificed in order to afford that handbag. So again, money is any asset that's a means of payment, that is a store of value, and is the frame of reference or unit of account. Okay? So it's a commonly accepted metric that people use to set prices and to make economic values or calculations. Each of these 3 things interact with each other. If money was a terrible store of value, we would never use it as a unit of account. We would never accept it as a means of payment. So if the asset that we call money suddenly becomes a really crummy store of value, why would we use it as a measure? Why would we accept it? Okay, so they're very much connected. So now we're going to talk about those commercial banks. Banks out there in the private sector. And we want to talk about the role that those banks have in determining the money supply. In order to do so, we need some more definitions. Yes, we always need definitions. But we also need some assumptions so that we can make our discussion more focused. The definitions help focus our discussion, and the assumptions help focus our discussion. So in order to understand how the money supply is being determined and the role that private banks play, we need to talk about things like bank deposits in a different detail than we said earlier today. Remember, M1 had certain bank accounts, bank deposits. M2 had even more bank accounts, bank deposits. And M3 had more bank accounts, again, bank deposits. In each of those 3 cases, M1, M2, and M3, those accounts were at chartered banks. Okay? So let's talk about what banks do, sort of the big picture. So to step back and say, in very broad general terms, a bank is a financial intermediary. Intermediary means it's a middle party. It stands in between other parties. It flows assets into the bank and flows assets out of the bank. It helps channel funds. The bank accepts deposits from savers and converts these deposits into loans to borrowers. So in some sense, when it's accepting deposits from the savers, the bank is borrowing from the savers and lending to the borrowers. It really is an intermediary here. Most of the funds that the bank is lending out are not their own funds. They're someone else's funds that the bank has borrowed. Okay? So a bank accepts deposits from savers. They sell bank accounts. And then you turn around and they buy loans. They make loans to other parties. So again, channeling funds. Channeling from the savers to the borrowers. And of course, the bank can also make other investments. They can own some bonds, some stock, some real estate, whatever. But we're going to emphasize the deposit taking and loan making operations of the bank. So again, deposit taking and loan making. Charter banks do this. Credit unions do this. Case populaires do this. Mortgage and loan companies do this. Trust companies do this. All banks take deposits and make loans. So the deposit taking and loan making institutions. So let's take a look at the balance sheet of a commercial, in this case, chartered bank. We've got assets on one side of the balance sheet and liabilities and equity on the other side of the balance sheet. We call this a balance sheet because the value of the assets on the left and the value of the things on the right have to balance. We total up all the assets and we get a number. We total up all the liabilities and equity and we get a number, and those two numbers are the same on this balance sheet. Also, since we're taking such a big picture look at the bank, we don't have very fine categories for the assets, very fine categories for the liabilities and equity. We take the broad categories. The assets of the bank, all the loans they made. They made the loans to the borrowers, and that's an asset to the bank because the borrower owes the money back to the bank plus interest. So that's a valuable asset owned by the bank. The bank also has assets that are called bank reserves. Any cash that the bank has kept in its vaults to, pay bills, to pay back depositors. So reserves refers to, right, bank reserves, or reserves for short, refers to all the currency that the banks hold in their own vault or they put on deposit at the central bank, in this case, the Bank of Canada. So that's what bank reserves are. All the cash that the bank holds in its own vault or it puts on deposit at the central bank. So those are the assets of the bank. Liabilities, well, they borrowed from the depositors. So the main liability of the bank then is all the deposits they owe back to the depositors. When Jack deposits $100 into the bank says, thank you very much, I owe you that in return. I'll give it back to you in the future with some small amount of interest. So the main liabilities of the bank, they owe back all the deposits. So DD here for demand deposits. The bank also has some equity. The investors that started up the bank put in their own equity, their own funds to start the bank up. And hopefully, if the bank has been successful, not only has that pool of equity been maintained, hopefully the equity has grown over time so that their initial investment has become more valuable. Okay? So again, balance sheet, we take the loans plus the bank reserves, and that has to equal, right? The sum of these two must equal the sum of these two, deposits plus equity. Rearranging then, equity equals the assets, the loans and bank reserves, minus the deposits, which are the liabilities. We take the assets minus the liabilities, we get the equity. That's the bank's capital. And again, when the bank first gets set up, there's some capital injection to start the bank up. And if the bank is successful, that capital not only stays positive, but hopefully grows in value over time. Sorry about the typo. Modern banking industry is characterized by what is known as fractional reserve banking. The reserves are only a portion of the deposits. Jack puts $100 deposit into the bank. Only a portion of the $100 is held in reserve. The bank says, oh, Jack's not going to be back tomorrow for the $100 back. We don't have to put the whole 100 in the vault expecting him to return tomorrow. We put a small portion into the vault on reserve, and we lend out the rest. So modern banking, characterized by fractional reserve banking, where the banks accept deposits, hold a small fraction of the deposit as reserves, and they lend out the rest. They're deposit-taking, loan-making institutions. So the so-called reserve ratio, RR for reserve ratio, is the percentage of the deposits that a bank holds as reserves. Take the reserves over deposits. And that's your RR. It's a positive fraction. Some number like 5% or 15% or 10%. Okay? Let me sneak this a little further north. The maximum, note the word there, the maximum amount of deposits that can be supported by a given amount of reserves is then DD for demand deposits, 1 over the reserve ratio times the reserves. Right? So remember, for a given amount of reserves, knowing that amount of reserves, knowing the reserve ratio, we plug it into this formula, and that tells us the maximum amount of deposits that are being supported here by those reserves. This is very similar to the logic of the multiplier, because remember, this is 1 over a fraction. 1 over a fraction is a number bigger than 1, isn't it? If the reserve ratio is 10%, then 1 divided by 10% is 10. Oh, if the bank wants to hold $1 million in reserves, $1 million times 10 means $10 million worth of demand deposits. That's what we're saying, right? It's a multiple, very similar to the multiplier in the income expenditure model. Okay? Now, remember, we're still talking about this fractional reserve banking. We're still talking about the private banks. Now, there are some problems here that can pop up. And one of the problems with private banks is the bank could get itself into trouble. The bank could see that its equity is shrinking. It could see that its reserves are, not in great shape. And so the fractional reserve banking system implies the banks might get hit with a sudden, very rapid set of withdrawals by depositors. And if the withdrawals by the depositors is so fast that they start running out of reserves, then what's the bank supposed to do? If it's running out of reserves to pay the depositors, now it has to start selling assets. It has to start selling loans. And it might be forced to sell loans at a very bad time in the business cycle, which means it might lose money on those loans. Right? So again, fractional reserve banking means the banks might get hit with a sudden, very quick set of withdrawals by depositors, and they might find they don't have enough cash on reserve to satisfy the demand for withdrawals. Right? This is what's called a bank run. There's a run on the bank. And this kind of bank run can lead to a bank failure. The bank can collapse because they might end up, like I say, selling the assets for less than they're truly worth and end up not being able to cover all the deposits, wiping out all the equity of the bank, and the bank basically could go bankrupt. So a bank run can be a very, very nasty situation. It also can be self-fulfilling and can be kind of viral, like a contagion. Rumors can start circulating. Did you hear? Right? ABC Bank is in trouble. Do you bank at ABC Bank? If I was you, I'd go down there and take all your money out before it's too late. And you hear a rumor like that, and you're like, wow. I don't know if the rumor's true or not, but even if it isn't true, there's no harm in taking my money out and protecting myself. Because if it's true and I ignored this, man, I could have ignored a big loss. I could have saved myself from a big loss by not ignoring this. So rumors can be self-fulfilling because people, the bank could be in great financial shape, but rumors start circulating on social media or whatever. People start hearing that ABC Bank is in trouble. Enough people believe it. Enough people go to the bank and ask for their money to be withdrawn. And now the reserves start dropping as they're withdrawing out of the reserves. And people hear, yeah, the bank's running out of reserves. You better hurry up and get there. And more people line up at the bank trying to get their money out. And like we say, it's contagious. And self-fulfilling perhaps, because a bank that was in good financial shape could end up being forced to sell assets at a loss and end up actually going out of business if things get really out of hand. So a bank run is definitely not something you want to experience. A bank run is definitely not something you want to be exposed to as an investor in the bank, as a depositor in the bank, or even as a member of society. Because a bank run could lead to, like we said, the bank failure, which may necessitate bailouts by the government or other stuff, because it could lead to further widespread difficulties. Remember we said about contagion? The posts on social media about ABC Bank could get shared and shared and shared and shared, and the beliefs become contagious. But also people might begin to believe that, well, if ABC Bank failed, what about, XYZ Bank? Maybe they're next. And then rumors start about another bank. It's almost like, those, Redditors talking about how to make money on stock. The rumors move from company to company, whether they be substantiated or not, but they can be self-fulfilling and contagious. Okay? If a country's entire banking system is being hit with, a bank run in multiple banks or in large enough banks, then a country is experiencing or is said to be experiencing a banking crisis. We don't want a bank run. We don't want even one bank failure. We definitely don't want a banking crisis, because this can lead to a recession, can lead to lots of unemployment, can lead to lots of economic hardship. So since we don't want these things, what can we do to help mitigate or avoid these? Well, we have regulators. The banks are not allowed to operate freely on their own. Just like, earlier today I mentioned something about taking a dog for a walk. Most of the time when someone takes a dog for a walk, they put it on a leash, so it's not allowed to roam freely on its own. It's more under your control. You can rest assured that you know where your dog is. It didn't run away. You know that your dog didn't supposedly bite the neighbor who claims it was bitten by the dog or whatever. So we regulate. Bank regulation is a way to reduce the odds of a bank run, reduce the odds of one bank failing or even a more widespread banking crisis happening. So given how disruptive a bank run is, policymakers take measures to try and reduce those odds, to reduce a run on one or more banks. In Canada, one of the main regulators for banks is the Office of the Superintendent of Financial Institutions, OSFI. They regulate banks and some other financial intermediaries, like insurance companies and pension funds and things like that. But right now we're talking about banks. So the Office of the Superintendent of Financial Institutions is a regulator for financial intermediaries, like banks. To stabilize the banking sector, OSFI uses the following tools: deposit insurance. For the chartered banks, the deposit insurance is created and sold by the Deposit Insurance Corporation of Canada, another regulator that works alongside OSFI. But OSFI dictates that every chartered bank has to have deposit insurance. Every trust company, every credit union, have to have deposit insurance. And what deposit insurance does is it reduces the odds of a bank run. Because when a rumor starts circulating, hey, did you hear ABC Bank is in trouble? Jack, don't you bank at ABC Bank? I'm like, yes, I do. Well, shouldn't you worry and rush down to the bank and take your money out just in case the bank fails? I'm like, even if the rumor is true, and I'm not sure whether it is or is not, even if it's true, it doesn't matter because my bank account is insured. My deposits are insured. And so even if the bank fails, I'm going to get my money back from the insurance company. So I'm not in a rush to run down to the bank. And so the deposit insurance is like a circuit breaker that reduces the pressure or odds of a bank run. Because a whole bunch of people sort of snap up in their seats and go, I don't need to rush to the bank and take my money out. My money's protected. If we lived in a world without deposit insurance, even the rumor of a bank run, even if you don't believe the rumor, you might rush and take your money out because it's not insured, right? Better safe than sorry, as they say. But deposit insurance, like I say, is an important backstop or circuit breaker to remove pressure for bank runs, to make the banks as a whole more sound. Another thing that OSFI does is they require the banks to hold significant capital. So there are capital requirements. The banks are required to hold more assets than the value of their deposits. In terms of that balance sheet we saw earlier, that means the equity has to be positive because the deposits are smaller than the assets, right? So the equity has to be positive, and not only positive, it has to be enough positive. It has to be big enough. In essence, what OSFI is saying is, don't worry about the viability of the institution. Not only is there deposit insurance, the bank is sitting on a whole bunch of its own capital, and it will use that capital to survive. It won't go underwater and drown very easily because we forced it to be well capitalized. It makes it more resilient so that it doesn't fail in a small recession. It doesn't fail even in a medium size or a bigger recession because it has the working capital it needs. Another thing that can come into play, notice I said can come into play, I didn't say it must come into play, is OSFI can regulate reserve ratios. They no longer do this. Prior to 1994, chartered banks in Canada were required by law to maintain minimum reserve ratios. But after that date, they now hold voluntary reserves. So now chartered banks hold voluntary reserves. Nobody makes them do it. They just voluntarily do it because it's prudent as part of their business to hold reserves to maintain their day-to-day working capital and day-to-day needs. To have those reserves makes sense. Keeps their costs down and their profits higher. Okay? They need to have those voluntary reserves to meet the daily withdrawals of their depositors and keep bank runs at bay. So now we're going to talk about how the banks create money. So we're going to examine how banks create money through the deposit-taking, loan-making process. Private banks create money out of thin air by taking in deposits and making loans. So how do they do it? Well, we use the definitions we built up so far, but also we need some more assumptions. Okay? So here's the setup of our little model to explain how the private banks create money, how they influence the money supply. For our purposes, the money supply will be M1. So the money supply, MS, for the nominal money supply, all the currency in circulation, plus all the demand deposits at chartered banks. So CC for currency in circulation, DD for demand deposits. So MS equals CC plus DD. We assume that the desired or voluntary reserve ratio, remember that little RR, is frozen at 10%. The government doesn't force them to do this. They have voluntarily decided to hold 10% reserves. If, and continuing on that notion, what does this mean? If the current reserve ratio is not 10%, the bank will adjust the amount of loans made to bring the reserve ratio back to the desired level. If the reserve ratio is above this or below, if it's above 10% or below 10%, they'll adjust the amount of loans until the reserve ratio is back to 10%. The bank does not hold excess reserves. So they want it to be 10% exactly, not below, not above. So reserves over and above that amount needed to satisfy the desired 10%, right, would be called excess reserves. So they're not going to hold any excess reserves. Actual and desired reserves will both be 10% of deposits. No excess reserves. Further in our modeling, agents out there in the economy want to hold a constant amount of cash. So the currency in circulation is constant. and they will deposit any extra cash into the bank. For simplicity, we assume, there's only one chartered bank in the entire economy. By having one chartered bank, then we can look at one balance sheet that describes the entire banking sector at one sheet. Okay? And so here is our initial balance sheet for our bank that we're going to use for all of our examples to come. Okay? So here it is. Assets, we have $940 worth of loans. We have reserves of $100. We have demand deposits of $1,000, and we have equity of $40. That's $1,040. That's $1,040. It balances. Hooray! Also, you will note the actual reserve ratio, reserves as a percent of deposits, is indeed the desired reserve ratio of 10%. Hooray! We really are in equilibrium here because there are no excess reserves. Finally, I also will acknowledge that the money supply is the currency in circulation plus the demand deposits. The demand deposits here are 1,000. We're going to assume that the constant amount of cash is $100. So currency in circulation, $100. And so the money supply right now is $1,100. So there's our initial situation. Okay? Now imagine my buddy, right? Comes into this story. And my buddy, in our example here, people are happy with $100 worth of cash, so that's the CC. And they deposit any extra cash into the bank. Now suppose my buddy Iris discovers $20 in cash under her bed. She's like, woohoo, $20. This is great. But she doesn't want to hold on to it because that's extra cash. So she goes to the bank and deposits it in the bank. And we want to ask what happens to the money supply. The initial money supply, after discovering the $20, the currency in circulation is now 120. The demand deposits are 1,000. The moment she discovers that cash, we have $1,120 worth of money in the economy. But since she found that $20, she goes and deposits it in the bank. Here's the new revised balance sheet of the bank the moment after Iris deposits the $20. So deposits used to be 1,000. Now it's got an extra $20 because she just deposited that. Equity has not changed. Loans have not changed. Reserves went up by $20 because the bank goes, oh, look, $20 cash. Thank you for the deposit, Iris. And it puts the $20 in the drawer or in the vault. So reserves went up by an equal amount. This is now, of course, 1,060. This now is also 1,060. Everything balances. It's still a balance sheet. Both sides have to balance. Okay, so plus 20 on this side, plus 20 on that side, they both still balance. But now the bank holds excess reserves. We want a 10% reserve ratio, but now reserves are 120 and deposits are 1,020. Right? You get your calculator out and you calculate, and that's more than 10%. It's almost 12%. So the actual reserve ratio is bigger than the desired reserve ratio. The bank has excess reserves. The bank says, darn, we got too many reserves. So the bank decides to make more loans. They don't want to hold so much reserves. So the bank says, let's make some more loans. Let's keep $2 in reserve, 10% of 20. So keep $2 in reserve and take the other $18 and lend it out. So lend out the other 18 as brand new loans. Okay? So that's the next step in this process. So taking this balance sheet, it carries over to the next one. That's why we're going to narrow down into here. So this is after the $18 loan got redeposited back in the bank. Loans went up by $18. There's that 100 plus 2 plus the $18 worth of deposits in a second. So loans went up by $18, but the $18 got deposited back in the bank, which meant that reserves just went up by $18. Oh, right? This side still balances, this side still balances, this sum and this sum are still the same, but our actual reserve ratio is still more than 10%. Because the $18 worth of loans got redeposited, because people only want to hold $100 worth of cash, which meant the reserves went up again. So now we've got $18 worth of new reserves, and think about that, we got excess reserves, so we're going to make $16.20 worth of new loans, right? Because we got that extra $18 worth of new reserves. Why don't we hold 10% of it as on reserve and lend out the rest as brand new loans? So take 10% of this and add it into here and lend out the rest as brand new loans. And we keep doing this on and on and on and on and on until the actual reserve ratio becomes 10%. This is a process that continues forever. Right? It's an infinite chain. I'll remind you, initially it was $20 and $20. Then it became 18 and 18. Now it's 16.20. It'll be 16.20, 16.20. Each time it's getting smaller and smaller and smaller because we keep taking the previous number, and the previous number, our first number here was 20, right? And now we've got 10% of that 20 disappeared as new reserves. So this was 10% smaller, and then 10% smaller, and 10% smaller, forever. If that process continues forever, the maximum amount of demand deposits gets created. Well, we go back to this formula. Demand deposits equals 1 over the reserve ratio times reserves. So the change in demand deposits equals 1 over the reserve ratio times the change of reserves. Oh, well, the change of reserves, we go back to step 1. In this whole process, Iris found the $20, put it in the bank, reserves went up by $20. That's the beginning of the process. So the change of reserves, $20. The reserve ratio, 10%. This is 10 times 20, $200. That's the overall change in the demand deposits when all the dust settles. That means we go back to this chart back here. We started with 1,000. We're going to end with 1,000 plus 200 because demand deposits went up by 200 when all the dust settles. Our brand new chart will have 1,000 there plus 200. Bank reserves started with 100. They went up by 20 because she found that $20. So there's the 20 here, the $20 of cash, tenfold there. That, of course, is the remaining $180 that makes this plus 200 on this side, plus 200 on that side. That's back in equilibrium. There's the bank when everything finally settles down and the reserve ratio is back to 10%. 120 is 10% of 1,200. Yay, we're back in equilibrium. Now what's our money supply? Well, we still have $100 worth of cash in circulation. And now the demand deposits are $1,200. So $1,300. The change in the money supply, the new money supply, $1,300, minus the old money supply, that's the old money supply the moment after she found the $20. $1,120. So money supply went up by $180. Change in demand deposits, $200. Change in loans, $180. Change in reserves, $20. That sum has to equal this. Okay, why don't we take a break? Okay, part 2. Now we want to talk about the central bank and the role it plays in the money supply. So the central bank is an institution that oversees and regulates the banking sector. They design and implement monetary policy for the nation. So Alberta and Ontario don't have central banks because we participate in the union that is Canada. Canada itself has one central bank. Okay? So the functions for the central bank include the following. So in Canada, the Bank of Canada, BOC if you like acronyms, so the Bank of Canada is Canada's central bank, and it does the following important functions. Number 1, and not necessarily in order of importance. Number one, the Bank of Canada serves as the lender of last resort. If a big bank needs a loan, they turn to other big banks and ask each other for loans. Yes, they compete with each other, but they also cooperate. If Jack's short $50 million and needs to borrow funds and your bank has the funds, you're willing to lend it to me as long as I pay you a fair interest rate. But if I can't get a loan, I ask around all the banks and I'm unable to get a loan to meet my needs, to meet my capital requirements, to meet my voluntary reserve ratio, whatever, then I can turn to the Bank of Canada and I can get a loan. It's called the lender of last resort because I turn to them as my last resort. I tried all the private sector institutions first. So the interest rate that the Bank of Canada charges chartered banks is called the bank rate. Okay? If the Bank of Canada wants to, it can charge a lower rate. But usually the lender of last resort loans are made at what's called the bank rate. And the bank rate is highly publicized in the economy. Okay? Number two, the Bank of Canada acts as the banker for the federal government. The federal government of Canada has bank accounts at private banks like the Royal Bank or the Bank of Montreal, but the federal government of Canada also has money on account at the Bank of Canada. You and I can't open a bank account at the Bank of Canada. It's a special bank that only does business with the federal government and with the big banks. It does not do business with smaller entities like us. Okay? So the Bank of Canada acts as a bank for the federal government. It protects their money and keeps it on account for them and lets them make deposits and withdrawals. The Bank of Canada issues currency. $20 bills and $5 bills and so on proudly say on them Canada, but they also say Bank of Canada. And the Bank of Canada is responsible for not just the art that goes into those bills, whose portrait's on it, what color is it, but they're also responsible for the security features so that the money's only being issued by the Bank of Canada, not by fraudsters making counterfeits. Counterfeiting, of course, would undermine the value of money. So, yes, the Bank of Canada wants to keep Canada's money a good store of value. One way to do that is to keep inflation under control. Another way to do that is to make sure that the money is safe and secure and not easily counterfeited. So, the Bank of Canada issuing that currency. Number four, the Bank of Canada conducts monetary policy for the whole nation. In real life, the Bank of Canada does not have 100% complete control over the money supply. We've mentioned this before. You'll notice it's in, yelling there to make sure this gets through. Yes, I'm sorry, it's in capitals. Right? So the Bank of Canada does not have complete control over the money supply. However, they have very good control over the something called the monetary base. MB for monetary base. The monetary base is the sum of all the currency in circulation and bank reserves. So monetary base, currency in circulation, and bank reserves. The so-called money multiplier is how much the money supply will change when there's a change in the monetary base. So the money multiplier, the money supply divided by the monetary base. MS for money supply, MB for monetary base. And again, the money multiplier describes how much the money supply will change when there's a change in the monetary base. How does that process work, sort of? Well, when the monetary base changes, it will impact chartered banks' lending behavior. Remember the monetary base, bank reserves, currency in circulation. So if bank reserves change, that alters the behavior of the banks. So a change in the monetary base will impact chartered banks' lending behavior, which results in a change in demand deposits because people redeposit back in the loans, and that will change the money supply because the money supply is all the currency in circulation plus the demand deposits. And one would imagine that that change in the monetary base, making this cascade of effects, also puts into a whole bunch of effects. It's a feedback loop. It isn't just this happens, then we're done, because the actual reserves and desired reserves are probably not equal following first pass through here. Okay? Remember how we iterated through those balance sheets until we got equilibrium. Let's talk more about the background of the central bank. So the central bank is owned by the federal government. It's a part or an arm of the federal government. However, they're given a lot of freedom, a lot of autonomy, okay, to carry out their responsibilities. The operation of the Bank of Canada is overseen by a board of directors. 12 directors from outside the bank, each giving a viewpoint. Well, Alberta likes this, BC doesn't like that, this kind of stuff, so that we get a broad a feel or opinion about what are the economic needs of the various regions of the country. So 12 directors from outside the Bank of Canada, the governor, the head of the Bank of Canada, and the senior deputy governor, right? And the deputy minister of finance, that's a federal bureaucrat, sits on the board but doesn't get a vote. Okay? So only 2 votes from within the central bank itself, a lot of votes from outside the bank, so that the bank gets a good picture as to what are the various wants or needs of Canadians, no matter what region of the country. The governor of the Bank of Canada is appointed to a 7-year renewable term. So you sign a contract that lasts 7 years. And at the end of the 7 years, if you are so inclined and the government is so inclined, they can renew your contract and extend you for another 7 years. Okay? If there's a huge disagreement between the Bank of Canada and the government, the Minister of Finance can issue written orders specifying a particular monetary policy they want the governor to undertake. If the governor disagrees, the governor either resigns or they get fired. So far in Canada's history, no governor's ever been fired. But I will also admit that this mechanism to remove the governor is a fairly new mechanism. The central bank was created in 1935 during the Great Depression. This mechanism to remove governors wasn't introduced until the 1960s. Okay? So there you go. So let's talk about the tools that the central bank has to control the money supply. Okay? So we're going to discuss those tools. We're going to emphasize 4 different tools used by the central bank to influence the money supply. Number 1, reserve requirements. Yes, we don't use that tool anymore, but it is a tool that we could use if we so desired. The Bank of Canada can talk to OSFI. Together they can rewrite the rules and say we're going back to fractional reserve banking. So reserve requirements. By adjusting the reserve requirements, it influences the amount of loans that banks can make for a given amount of deposits. Thereby, it changes the money supply. Right now, if we pretend there's a voluntary 10% reserve ratio, if the government came along and said, no, we're going to mandate that you have to hold 15%, then for the same amount of deposits, the banks are forced to hold more reserves, which means less loans. And that will influence the money supply. Okay? So again, adjusting reserve requirements can influence the money supply. Banks will make fewer loans if the reserve ratio goes up for any fixed amount of deposits. Because, think about it. For a fixed amount of deposits, gives you a certain amount of reserves. If the reserve ratio goes up, you're not able to support as many deposits. Oh, if demand deposits drop, money supply drops. Okay? In Canada, we no longer, like we acknowledged before, control reserve requirements, but we could always go backwards and change this if we wanted. Some countries do have their central bank control reserve requirements. China, for example. The Central Bank of China controls reserve requirements of banks. And so they will use that tool to manipulate the Chinese money supply. Number 2, the central bank can alter the bank rate. Yes, the bank rate we referred to earlier. That interest rate charged is a lender of last resort loan. Okay? So when chartered banks find themselves short of money, they will try to borrow from each other in what's called the overnight market. Listen to that phrase, the overnight market. Wow. Yes, it's exactly what that sounds like. That's a market for loans that last overnight. I lend you today, you borrow from me today, tomorrow you pay me back, unless we negotiate a longer term for the loan. So the loans are usually 24 hours or less unless you negotiate longer. So in this overnight market, we have the overnight rate of interest. So, however, if chartered banks are unable to borrow from themselves, from other chartered banks, they can borrow from the Bank of Canada at the bank rate. The bank rate is set as the overnight rate plus 1/4 percentage point. So generally, the overnight market interest rate is here, the bank rate is higher. And that's why this is a lender of last resort loan. No bank in their right mind wants to pay a bigger interest rate. If possible, if I need $50 million, I want to borrow at this rate, which is smaller, not that rate. I only go to the Bank of Canada as a last resort because I can't get enough funds. The Bank of Canada normally sets the target for the overnight interest rate 8 times a year. And that's a very highly publicized event. They talk about what's going on with the target. Is the target staying the same? Is it going up? Is it going down? So 8 times a year, they bring a lot of, put the spotlight on monetary policy and a lot of discussion leading up to those announcement dates. What's happening? Is the central bank going to keep the target where it is? Is it raising it? Is it lowering it? When the target goes up or goes down, the bank rate goes up or goes down with it. Okay? So, for example, suppose the Bank of Canada raises the target for the overnight interest rate. It is now more costly in the overnight market to borrow funds. So it's more costly for banks to borrow from each other or from the Bank of Canada, because that guy went up, plus the 0.25%, that guy went up as well, right? And so it's more costly for banks to borrow, so they have an incentive then to hold more reserves. You hold those voluntary reserves to meet your day-to-day cash management as depositors show up and ask for funds. But you might take your voluntary reserve ratio from 10% and say, given the interest rate just went up, maybe I should hold 11 or 12%. Maybe I should hold a little bit more reserves so that I'm less likely to need to borrow from somebody, because borrowing from somebody comes with a higher interest rate, a higher cost. So again, when the Bank of Canada raises the overnight rate, it's more costly to borrow in the overnight market. There's an incentive for banks to hold a greater amount of reserves. Right? Bigger reserve ratio means less demand deposits given a fixed amount of reserves. If demand deposits drop, the money supply drops. So an increase of interest rates puts in motion a cascade of events that causes the money supply to shrink. Right? If you're holding more reserves, that means you're making less loans off the same deposits. And that means the money supply is shrinking. The process by which a bank takes in deposits and makes loans and keeps only a fraction of the deposits on reserves creates money on paper. By having a bigger reserve ratio, it creates less money overall. So I repeat, an increase of the interest rate, right, makes it more costly for banks to borrow. They tend to hold more reserves. That cuts into demand deposits, makes the money supply shrink. So the money supply shrinks. And that's why people emphasize, is the interest rate going up or going down? Because the cost of borrowing is either going up or going down, or if it's staying the same. It's also talking about the money supply going up or going down, or staying the same. Another way the Bank of Canada can manipulate the money supply is something called open market operations. Open market operations refers to purchases and sales of government bonds by the central bank. So the central bank goes out in the open market for government debt and buys or sells treasury bills and treasury bonds. When the central bank purchases government bonds, the central bank is said to be carrying out an open market purchase. That makes the monetary base go up, and that makes the money supply go up. You might go, pardon me? Well, think about it. If I'm the Bank of Canada and you're a private sector citizen or firm or whatever, and you own a government bond, if I come and buy that bond from you, that's a purchase, right? If I purchase a bond from you, I pay you in cash, or I electronically put it in your bank account, and the monetary base is up, right? And that makes the money supply go up. If I paid you in cash, you say, oh, I got excess cash, you go deposit it in the bank. If I wired into your bank account, it's now in your bank, right? And the bank says, oh gosh, I got extra reserves, right? So the monetary base went up, the money supply went up. When the central bank sells bonds, if I sell you a bond, an open market sale, then the monetary base is shrinking because you're withdrawing the money out of your bank account to pay for the bond you just bought. Right? And so the base is dropping because reserves are shrinking and the money supply is dropping. So that's another way the central bank can manipulate the money supply by buying government bonds to increase the money supply, by selling government bonds to decrease it. So again, when the central bank carries out these operations, they change the base, which in turn changes the supply of money. So let's talk about one of those purchases. So go back to the setup of our model. You know, the standard balance sheet for our one chartered bank. And the public is happy with $100 worth of cash. And they deposit any extra cash into the chartered bank. The chartered bank has a desired reserve ratio of 10%. The initial equilibrium has the money supply equal to currency in circulation, $100, plus demand deposits, $1,000. We have a money supply of $1,100. Okay? So again, money supply, currency in circulation, plus demand deposits, $1,100. And now the central bank, you know, Jack's the central bank, and I go out there and I buy a government bond for $10. I pay $10 for the bond. The person goes, oh, thank you for the $10, and they deposit it in the bank because they don't want more than $100 worth of cash. And now reserves just went up by $10. This is immediately after the open market purchase. Now the actual reserve ratio, we got 1,010 worth of deposits, and we have 110 worth of reserves. We have more than 10% actual reserve ratio, which is greater than the desired reserve ratio. The bank has excess reserves, and they want to increase their loans. So they want to take most of this $10 and lend it out and hold back only a portion of it as reserves. You know, we could iterate like we did before. Take 10% of this and add it to reserves and lend out the other 9. Oh, but the 9 gets deposited, which means 9 here. Oh, take 10% of that, 90 cents, put it over here, and lend out the other $8.10, and you keep doing that repeatedly. Right? So, again, you do that stepwise, making more and more loans. And the amount of deposits keeps growing, the amount of reserves keeps growing, the amount of loans keeps growing. Right? You know, in round 2, you've taken that, you took 10% of the $10, put it in there, you lent out another $9, so that rose by $9. Right? That's up by 9. Oh. Balances? Balances. And again, the reserve ratio is still more than 10. Oh, you got to make more loans. So take 90 cents, add it into here, lend out the other 810, and you keep doing that forever, forever, forever. Remember the math, we saw it before. Demand deposits equals 1 over the reserve ratio times reserves. The change in demand deposits equals 1 over the reserve ratio times the change in reserves. In this example, the change in reserves was I bought $10 worth of bonds. That's why we have $10 there. We have the voluntary reserve ratio of 10%. So I've got 10 times 10. Demand deposits go up by $100 from our initial equilibrium to our new equilibrium. That's up by $100. That's 10% of the $100, and that's the other 90% of the $100. So loans are up, reserves are up, deposits are up, thanks to this monetary policy. Now let's take a look at what that means for the money supply. So the maximum change in the money supply coming from this $10 purchase of bonds, well, we have our initial money supply, currency in circulation plus demand deposits was $1,100. Our new money supply, the new currency in circulation is still $100, but the new demand deposits, $1,100. The money supply is now $1,200. The money supply went up by $100. even though I only bought $10 worth of bonds. So the change in the money supply, $100. Alternatively, the maximum change in the money supply, we can take our change in demand deposits, right, $100 and put it in there. Change in money supply was change in currency and circulation. Well, that didn't change because the people demand or insist on holding only $100 in cash. So the change in demand deposits was the change in the money supply, $100. There's that money multiplier. By buying $10 worth of bonds, but with a 10% fractional reserve ratio here, we created 10 times as much money because of the depositing and relending and depositing and relending and depositing and relending. That infinite geometric sequence there that converges to this answer. So the open market purchase is a form of expansionary monetary policy. We've increased the money supply. Okay? Alternatively, we could sell bonds. Suppose I sell $10 worth of bonds. I got a bunch of bonds in my vault as the Bank of Canada, and I sell $10 worth. Somebody out there in the economy buying that $10 worth of bonds makes a withdrawal out of their bank account. They take out $10. So deposits drop by $10. Means reserves drop by $10 because the bank needs to grab the money to pay the depositor. And now our reserve ratio, we've got 90 worth of reserves, we have 990 worth of deposits, and now our reserve ratio has dropped below 10%. It's below our desired reserve ratio. The bank wants to increase the reserve ratio back to 10%. The way they do that is they have to call back some of these loans. They have to call up some of the borrowers that they lent money to and say, yeah, check out the wording of your loan. Your loan allows me to call back a portion of the loan. You need to repay me some of the loan right now. I need the money. So the bank starts calling back some of the loans. That process continues forever until the change in demand deposits, again, the money multiplier times the change in reserves. In this case, again, the change in reserves was, minus 10. Minus 10 times 10, demand deposits drop by $100 from the initial balance sheet to the new one. Back in equilibrium, we got $900 worth of deposits. Right? We've got $90 worth of reserves. 90 divided by 900, we got a 10% reserve ratio. And we had to call back $90 worth of loans. Continuing that. So the maximum change in the money supply, when I'm selling $10 worth of bonds, change in the money supply, change in currency circulation, which didn't change. Change in demand deposits. Oh, demand deposits dropped by $100. The money supply is down by $100. By selling $10 of the bonds, I made the money supply drop by 10 times as much because the money multiplier being 1 over RR was a 10-fold change. So an open market sale by the central bank is a contractionary monetary policy because I made the money supply shrink. Okay? There's one more tool the central bank can use here to manipulate the money supply, and that's something called deposit switching. So deposit switching refers to the shifting or moving of government monies around the economy. Okay, step back for a moment, take that big picture view. I'll remind you, one of the hats the central bank wears is they are the bank for the federal government. The federal government has a bank account there with money on deposit. But the federal government also has bank accounts at the Royal Bank, at Toronto Dominion Bank, at the Bank of Montreal, etc., etc., etc. They have bank accounts in major institutions all around the economy. In our pretend model here, we pretended like there's one chartered bank. So let's just pretend there's one chartered bank. So the federal government has a bank account at the chartered bank, and they also have a bank account at the central bank. And they have a balance, they have money on deposit in both of those institutions. Well, the Bank of Canada can move money from one account to the other. Imagine the federal government has $100 on deposit at the charter bank and $100 on deposit at the Bank of Canada. So $200 overall. Well, the Bank of Canada can always say, well, why don't I take 50 of those $100 on deposit at the Bank of Canada and let's shift it. Let's move it over to the charter bank. Right? Deposit shifting or switching. When the Bank of Canada takes that $50 out of their account and puts it into the charter bank, money on deposit in the charter bank just went up. Right? Demand deposits just went up. Reserves just went up. The money supply just went up. When the money was sitting in the Bank of Canada's vault, it wasn't part of M1. Because M1 doesn't include money sitting at the central bank that is not, part of bank reserves. So again, deposit switching refers to the switching, the moving or shifting of government deposits between the central bank and the charter banks. It's used by the Bank of Canada on a day-to-day basis to manipulate the money supply. By transferring government deposits between part of the economy where it's not part of the money supply to part of the economy where it is, the Bank of Canada can influence the monetary base. Okay? By changing reserves, that changes the base, and therefore that changes the money supply. Excuse me. So, for example, suppose the Bank of Canada transfers government deposits from the Bank of Canada to a charter bank on the order of, say, $2 billion. Then the charter bank finds its deposits and its reserves went up by $2 billion. So reserves are up for the same reserve ratio. Demand deposits are up. The money supply is up. And yes, there would be that whole process where the private bank would have to adjust its situation to get to its desired reserve ratio. So that's what the switching is all about. The M1 money supply only includes the money on deposit at a chartered bank in a demand deposit. It doesn't include money on deposit at the central bank. That's not in the form of bank reserves. Another thing worth emphasizing or mentioning is the difference between interest rate targeting and money supply targeting. In the 1970s and early 80s, for example, the Bank of Canada tried to target the size of the money supply. They tried to explicitly state how much they wanted the money supply to be and how quickly they wanted it to be growing. They tried to control the quantity of money. But now we don't try and control the quantity of money. Instead, we target the rate of interest. Right? We have those 8 times of the year where they talk about what is the bank rate, what is the target rate in the overnight market. So nowadays, the Bank of Canada pursues interest rate targeting. They keep the interest rate at a target or pre-specified level instead of money supply targeting, which would keep the money supply at a pre-specified level. So why do they choose interest rate targeting instead of money supply targeting? Well, there's a number of reasons. For example, the Bank of Canada does not have 100% complete control over the money supply. So why are we trying to state a number that I want the money supply to be this number, but I don't control the money supply perfectly? But they can control the overnight interest rate almost perfectly. When they say, I want the overnight interest rate to be 1%, then it basically is 1%. And they have tools to make it stay at or very near to 1%, very simply and very easily, almost every day. Another reason is it's easier for agents out there in the economy, firms and households, to understand what is meant by the interest rate target. What is meant by, oh, the interest rate just went up or just went down. They can relate to, oh, the cost of borrowing is rising or falling. They can't relate to, oh, we're making the money supply a bigger or a smaller number. Right? They go, I don't know what that means exactly, but I know exactly what it means when the interest rate moves from 1% to 1.25%. I can calculate what that means for my borrowing costs right down to the penny, even though we don't use pennies in physical sense, but we do electronically. Okay? So this is more relevant, easier to relate to, easier to control That's old school and harder to relate to and not exactly under our control. Monetary policy has to pick one thing to target, and this is the thing that we're picking. We're targeting the rate of interest to try and control the money supply process so as to achieve our goal of inflation in and around 2%. Okay? Stay safe, everyone. Be well.